This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Lou Ann Fulmer, and I just want to welcome you to the Rocket City Retirement Show. Of course, I'm here with certified financial planner and financial advisor Cris Wallace. He's president of WG Financial Group. So happy to have you with us today. Thank you for spending part of your day with us. Now, always, Cris gives you some really good information about retirement planning. So if you would like to reach out to Cris, remember, it's complimentary, guys. Here's the phone number, 256-937-2010. You may call that number. If you prefer to text the word visit to 256-937-2010. It is a complimentary discovery session. We'll be talking about that throughout our show today. Remember, you can always check us out on Facebook because Cris will have updated things throughout this week. Okay, we're recording on a Tuesday, so who knows what's going to be going on throughout the week, and he'll have anything updated at WG Financial Group 256. Remember, the motto here at WG Financial Group is plan, retire, play. You can find us online anytime at WGFinancialGroup.com. And this show is available on Spotify now or any Apple Podcasts. Just search for Rocket City Retirement Show. And Cris, hello to you.
Hello to you, Lou Ann.
I am very excited to be doing this show with you today on Election Day.
It is. It is Election Day. Very stressful day.
It is kind of, I'm trying to not go there.
Are you anxious?
I'm a little anxious because of what may come ahead. And obviously, we're not going to know anything tomorrow, right? I mean, how could we?
No, I don't think so. I think it's going to be days. I've been on my phone all day. So you know how you get that screen report at the end of the week on your phone? It says, oh, you looked at your screen.
Oh, yeah. How many times? Yeah.
Yeah, mine's going to be way up this week because I've been all over the phone this morning, just doing normal work stuff, but also just with the election and just checking the betting markets. And actually, since we're live and recording right now, I'm just looking at the betting markets, and I'm not a betting guy.
Bet? Like betting like in Vegas?
Yeah, that's right. So if you look at the betting markets with a T, betting, not betting.
Betting, yeah.
Like Bed Bath & Beyond.
Yeah, not that.
No, betting markets, which is what I've been sort of paying attention to.
Oh, my gosh.
As of right now, we're recording. It's about 1:30 on Tuesday, and there's a 62% chance Trump wins the election. So there's been quite a bit of spike from last night. There was quite a bit of drawdown, actually, over the weekend. And then since last night, it's been spiking back up. And like I said, as of this moment at 1:30, there's like a 62% chance that he wins the election. And this is the, again, the betting odds here. So
interesting. I've never thought to look at the betting odds. That's funny.
Yeah. Well, you just look at like NFL games and teams and other things that Vegas bets on. Mm-hmm. They seem to know stuff that we don't know. And I think that's why I started looking at that. Because I don't really, if I'm being honest, I don't really believe a lot of the polls that are out there.
No, I don't either.
Yeah, I just don't know if they're, if the media is showing polls to make people stay home or or get them to vote or whatever. I just don't know. So I started looking at that a while back, and looking at the swing states and all of those when it comes to the betting markets, and tend to have a little bit more confidence there. But we'll see. I mean, to your point earlier, it's going to be days. I think it was like Arizona. That was like, what was it, like 10 to 13 days before they would know something?
Oh, wow.
Because
their machines broke down, right? Is that with the Kerry Lake governor decision?
Yeah, I don't know why. I didn't dig into it because it's just like, in my mind, I'm just like, we can, issue trades in security accounts. Like any of us that have investment accounts can go in and perform a trade, and it's done within just a couple minutes at best. And we've got all this technology and all these voting machines, and you're telling me we can't count votes.
Yeah.
It's going to take weeks to do that.
Ridiculous.
I mean, come on. Really.
It's just upsetting. It just kind of makes your blood boil, because then that's when you worry about cheating taking place,
Yes. Yeah, for sure. For sure. And so I guess that leads me to kind of the positive thought that I'll do today is the election season is almost over.
Thank you, Lord.
Yes. I'm so sick of all the ads.
Same.
Yeah. And some of the ads are just wrong and just outright lies. And snippets of conversation, and it's just.
Can I say something here?
Yeah.
Why do they allow lies? Because I've seen them. I'm like, that's a lie.
Yeah.
So and so would never say that. How can it be taken out of context? That is
so
wrong.
So divisive.
Yeah.
And it's been exhausting for me. And I know just sitting down with prospects and even clients of ours that we're meeting with, you can see the exhaustion on some of their faces.
Yes.
You can hear it, the emotion in their voice. And people are just genuinely concerned. And it's almost to the point of fear in a lot of cases.
Oh, it is. I think it's all fear.
Yeah. And it's really sad for me, honestly, sitting across the table that, I'm meeting with somebody, whether they're a client or not a client, and looking at the way that they're having to, just dealing with it emotionally. And I'm thinking to myself, like, you're in your retirement, what should be like glory years. And this is such a heavy weight on people. And I understand that because it's a heavy weight on me because I have kids and I think about their futures and things like that. So these elections are important, but it's just gotten so heavy for a lot of people. And I just can't wait for it to be over with, regardless of the outcome, and just so that we can look forward and not have to, worry anymore. So,
yep. And stress. Yes. So true. I'm with you.
Sure.
I love that positive thought. Thank you.
Yeah.
It's over. It's over almost.
Almost.
Kind of.
I mean, it'll be, well.
But then.
Yeah. I mean, good grief. I don't even want to like speak into existence all the things that probably could happen and how long this could like literally drag on. It's just, like I said, it's exhausting. So let's talk a little bit about the market. Okay. So year to date, the S&P is actually up 21% on the year. The Dow Jones is up 11.86 and the NASDAQ is up 22.63. The Bloomberg aggregate index, that's really what we would call like the bond index, the intermediate bond index is up 1.9%. So all indices are positive for this year. So that's good. But if you look at the ag index, it's actually been dropping. I'll kind of get into that here in a second. But on 11/7, so there's another important day this week that's coming up here in a couple of days. It's the Fed meeting, and this is where they're going to announce that there will be another cut, 25 basis points. So I'll go ahead and kind of spoiler alert it for everybody. So on 11/7, according to the futures, there will be another 25 basis point cut. And this has really already been priced into the market. And if you look out to December and we go out to the 12/18 meeting, I can tell you that the market is leaning towards another 25 basis point cut.
Dear.
But I think it's a little bit too early to make that call as we get closer. Like I'm pretty comfortable right now, according to the futures, kind of saying that on 11/7 there'll be another cut.
Okay.
I'll be really surprised if they don't cut. But once you get into 2025, this is where, again, we're a couple months out of this point. And I think, at least at this point, it looks like the markets are predicting a pause. And I believe that the market's kind of overreacted. I've said on the show before that people tend to overreact and markets tend to overcorrect. I think the 10-year Treasury actually overcorrected, meaning I think investors thought that the Feds were going to cut rates a little more aggressively. And I can just tell you right now, the data is not supporting cutting more aggressively at this point.
Okay.
Inflation is kind of come down, but it's not coming down at the rate that it once was. The other thing that I'm wondering, and I may have mentioned this on a previous show, but I'm just kind of wondering why they started with an aggressive 50 basis point cut right out of the gates, like 50 basis points. I would have thought that maybe you could have started maybe a little sooner and maybe just done 25 and 25 again if you wanted to cut. But they started right out of the gate pretty aggressively. And to me, and I think to many people that follow the markets, I don't think it made a lot of sense. So
I wonder what that was about.
Yeah, I don't know. I'm sure they have their reasons, and that's all fine and well. To be honest with you, the Feds don't have a really good track record. So, we'll see what happens in the future.
Okay.
But, on the note of cutting and rates and bonds and all of that, since September the 22nd of this year, the ag index is actually down about 2.68%. So since September 22nd, you've seen the aggregate bond index drop down 2.86. Now, the reason for this is over that same time period, the 10-year Treasury yield has risen about 17%. So remember, rising yields, falling bonds.
Okay,
right?
Gotcha. Okay.
So this is, again, I think it is the 10-year yield repricing going, oh no, we overcorrected earlier, and now we've got to uncorrect some of those cuts we thought were coming at a much more aggressive rate. And you've seen the 10-year Treasury yield rise about 17% since the middle of September. And this has, again, put downward pressure on bonds. Now, I mentioned, again, that they're positive. The Ag Index is positive 1.9 for the year, but in the past 2 months here, it's basically wiped away 2.68 of that return, or otherwise bonds would be up, close to 4.5% at that point. But we're not there because of the rising 10-year yield. So I want to move into a few more housekeeping items. Okay. And some of this we've talked about on previous shows. I know some people listen to the show and they go, they talk about the same thing all the time. Well, these sort of things that I'm going to talk about today, I think warrant repeating because unfortunately, I should say, as a show host here, we don't have everybody listening every week. And I think it's just good information to kind of go back and revisit some things. So the first thing I'll talk about is the Social Security COLA for 2025. It's set for 2.5%. So that's been decided. So in January, there'll be a 2.5% COLA assessed. Now, you notice that it's a lot less than it has been in the previous years because inflation has come down. So therefore, the COLA is actually going to be less. Something I found pretty interesting that you just may want to know that if you're listening to the show. A maximum income earner who was born in 1963 in 2025, not born in 1963 in 2025, but they'll be turning 62 in 2025, which means they were born in 1963. Gotcha. Okay. They will have a primary insurance amount of $4,020.90. So almost $4,021. Okay.
What's a primary insurance amount?
Yeah. So it's the amount that you would get at your full retirement age at 67.
Okay.
So that's the full, if you were just today, driving down the road, which I know you're not, it's kind of meant as a joke here, but if you're just driving down the road thinking, you know what, I wonder what the maximum Social Security amount is at age 67. Well, in 2025, it'll be $4,020.90.
Okay.
Now, again, that's what you would get at age 67. But we have to remember during the ages of 62 to 67, so while you're waiting to get to that PIA amount, you're also going to be getting COLAs along the way. So that amount that I just gave you could even be higher because you start assessing the cost of living adjustments from 62 to 67. Because remember, if you're listening to the show today, at 62, if you're deferring, you not only get the delayed retirement credits, you also get the COLA as well. So for people that are 62, this COLA that's going to be 2.5%, you're going to get your delayed retirement credits, which from 62 to 64, if you were born in 1960 or later, is actually the growth on your Social Security is 5%. So next year you would actually get a 7.5% bump, COLA included into your Social Security calculation. So all of that said, I can't stress enough why or how important making the right Social Security decision is for retirees. I think a lot of people, engineers included here mainly, they do their spreadsheets, and I have a lot of people come in the office and they bring their spreadsheets and we laugh about it and we joke about it, and they're doing break-even analysis, et cetera. Yeah. But at the end of the day, I think there's a lot that goes into the Social Security decisions and for a husband and wife. And I just think it warrants really, really, really looking at that, probably outside of just a spreadsheet. So, all right, now we'll get into a little bit more of some things I've covered here in the past couple of weeks, but I really want to go over them because I think that people listening to the show need to hear this kind of information.
Okay.
So starting in 2025, you can now put in $23,500 into your 401k if you're below the age of 50. So the normal contribution maximum amount you can put in is $23,500. If you're 50 or older, so remember, and I've said this many, many times on the show, in the year that you turn 50, you can put in an extra $7,500. You don't have to wait till you're 50. If you're 50 by the end of the year, you can make sure you can put in catch-up contributions.
Wow.
So that actually takes your total up to $30,500 that you can put into. Actually, it's $31,000.
31,000.
Correct. Sorry about that.
That's okay.
So you can put in $31,000, into your retirement plan, and that's important for you to know because you want to start thinking about that as the year flips. Okay.
Okay.
Now, also starting next year, it gets confusing. But again, this is why we talk about it. If you are going to be 60, between 60 and 63, then you can do that extra catch up that we talked about, I think last week. I think we had to run another rerun last week because I've been doing some traveling and training, et cetera. Yeah. So if you're 60 to 63, you can put in $11,250 starting next year. So I think that's a good amount of money that can go into the retirement plan. And don't forget, it's not $7,500 plus the $11,250. It is it's just $11,250. Okay, gotcha. Right. So if you add that together, you're looking at, if you're 60 to 63, starting next year, you can actually put in $34,750 into your 401k. And that's helpful because I think there are some late savers out there. I mean, good grief, we've all had kids, but there are some listeners that maybe don't have kids or have young kids. Kids are expensive and life happens, and the ability to put in extra money into your 401k, I think, is a really good thing. So again, from 60 to 63, you can put in an extra amount next year. All right. Now, here's another really important piece of information regarding certain 401k plans. And I bring this up again. I think that I touched on it here in the last couple of weeks, but it warrants repeating because with these extra amounts that you can put into your 401k plans, it really opens a door for some additional savings. So there are certain plans out there, 401k plans, that allow you to put in after-tax dollars. Okay, so what that really means is once you've maxed out dollar-wise the contributions that we just went over, so $23,500, you've done your max out of catch-up, and then there are certain plans that allow you to put more in at that point, and you can do that in the form of after-tax dollars. Okay, so let's start with the very basics here. With a 401k plan, and most people don't know this. There'll be some that know this because they've listened to the show, and then there's some people that have researched this and they found it and they understand it. In a 401k plan, you can put in $70,000 total between you and the employer. Okay, so some people say, no, wait a minute, I can only put in $23,500. You just said so. Nope, the 401k plans, if your plan allows this, you can put in up to $70,000. Again, this is your contributions plus your employer contributions. So, for example, you put in $23,500. Let's just say your employer matches $6,500. So at that point, you've put in a total of $30,000. So you take the delta between 70 and 30, and there's still room for an additional $40,000 that can actually go into the plan if your plan allows for it. So if your plan allows for these, what I call after-tax contributions, and again, there's a very small amount of plans out there that offer this benefit. It's around 21% nationwide. And spoiler alert, if you're a federal employee, you don't have this option in the TSP, so it doesn't apply to you. It will apply to some employers, employer plans in the area. Right off the top of my head, I know Boeing allows something like this. So if you're a Boeing employee, it's worth taking a look at. And if you need help with it, just come in and see us. We're happy to help with these types of things because that's what we do. We dig into these things to really find the nooks and crannies where we can really help a family kind of push away and save away a little bit more money. And the reason this is beneficial. Okay, so let me talk about why the after-tax contributions are beneficial. Let's just take the example I made here. You can put in $70,000, and let's say you put in a total of 30, so you've got a delta of $40,000. And let's just say you make good money, and you're literally you've maxed out your 401k, and you've got all this money coming, and it's just going into your bank account, and you're just putting excess money into savings. We know that money in a savings account, which is making a reasonable interest rate today, if you're making a high yield savings account, if you're in a high yield savings account, maybe 4%. Let's just call it that. So you're putting money in the savings account, and you're like, okay, it's great. It's going into savings. I got extra money in savings now, but you're yielding, say, 4% on that, and you're going to be taxed at ordinary income tax rates on the interest that you're earning in the savings account. The after-tax money that goes into the retirement plan, the 401k, can actually be rolled to a Roth IRA at a later date. So if you have like excess money and you've got more than enough coming in, you're just saving in excess, it's much more efficient to put it in the after-tax portion of the 401k because in the future it can be rolled to a Roth IRA, where you can't roll your savings account to a Roth IRA. At best, if your modified adjusted gross income is low enough, you can make Roth IRA on the outside contributions. So that's why it's really important that if you're working, for a company that has a 401k or a company-sponsored retirement plan, that you understand all of the options that are out there. And because I've been in the industry a long time, again, being a certified financial planner and financial advisor, I have familiarity with some of these retirement plans and how they work. And it's basically a simple phone call that you do there. So let me stretch this out a little bit further. So I just told you that the most you can put in is $70,000, right? That's what I just said. Well, if you're 50 to 59 years old, you can actually put in a total of $77,500. And let me take it a little step further, because we've got all these new rules now because of the Secure Act 2.0. If you're 60 to 63, that total actually jumps to $81,250 total between you and the employer. Because remember, it's not your contributions, it's a combination, or it's not just your contributions, it's a combination between you and the employer. And that's the way 401k rules work. You can put in up to that amount. When you hit 50 to 59, remember there's that catch up. That's why the amount goes to $77,500. And then if you're 60 to 63, remember we talked about that extra catch up just a few minutes ago. And that's what pushes that total up to $81,250 that you can put in 2025. So this is really important because every way. So I think what it boils down to with a lot of people there in Huntsville, we have a lot of really good savers. I know our clients, our prospects that come see us have saved lots of money for retirement. Let's just say it that way. So they're really good at saving. What I'm really good at is assisting you in ways to be efficient with your savings. So we want to make sure that we're saving in the right order. And I call it order of operations. And I've talked about it before on the show where I think we used to go by, what was it? Please excuse my dear Aunt Sally back in school.
Yeah.
Right? I think it was called PEMDAS. Well, I remember I was doing a show a couple of years ago and I was talking about order of operations and I called it PDMAS instead of PEMDAS. And I just happened to let my wife hear that section of the show and she's like, you moron, it's PEMDAS. And she was giving me like a really hard time.
I remember that. I so remember it.
Yeah. So certain things you just don't forget. And I knew, and I said it was, please excuse my dear Aunt Sally, but I called it PDMAS instead of PEMDAS. And she just thought that was hilarious. She got to joke on me and that show aired and there was no correcting it because sometimes you say things and it gets on air and there's literally nothing you can do about it. You just have to kind of roll with it. So that's a lot of information on 401ks, some upcoming changes. When it comes to IRA contributions, a couple things here I'll just kind of touch on. The contribution limits didn't change. So $7,000 in 2024 is the same in 2025. The catch up, if you're in the year that you turn 50 for an IRA or a Roth IRA, is actually $1,000 still. So you can put in $8,000 and $8,000. One quick note here, I won't go through the modified adjusted gross income limits, but there are certain times, if your modified adjusted gross is low enough, you can make an outside Roth IRA contribution. If you are an active participant in an employer-sponsored plan like a 401k, like we've been talking about, and you make over a certain amount of money, you cannot do both 401k contributions and a deductible traditional IRA. You could still do the Roth if you're low enough in modified adjusted gross. But if you're an active participant, then you can't do a 401k and then do a deductible traditional depending on how much money you make. So just important notes there. And the reason I bring this up, I actually had a client of mine send me an email today asking if he could make a traditional IRA contribution. And I was like, no, you can't do that because one, you make too much money, and two, you're an active participant. So these types of things are just, helpful for people to know. And these are things that we look at in the office again when you come in and sit down and do your discovery session. We go through our planning process. We're looking at all these avenues for you to try to help you out. All right. The last thing I want to touch on here before we jump off into the second part of our show is it's open enrollment for a lot of companies today. So now's the time where you can make your health insurance decision. Again, the reason I decided, hey, let's just talk about this on today's show is because this same individual emailed me and he was letting me know that he was considering doing a high deductible health plan so that he can contribute to an HSA. And I'm sitting there going, well, hallelujah. That means he's still continuing to listen to my show because this is a radio listener, a longtime radio listener. And we talk about HSAs. And I think Graham on one of the shows says that I love Jen first, and then I love HSA second. That's how much I love
That's how much you love them.
Yeah, because I think they're an excellent vehicle that gives you, in my opinion, it's not my opinion, this is the reality. It's like triple tax advantage. So with an HSA, now again, to do an HSA, first off, is not an FSA. So it's not a flexible spending account. It's a health savings account. You have to have a high deductible health plan, and you have to have one that qualifies for you to be able to use an HSA. So that part has to get, you have to establish that first. The great thing about these is most people are just going for their physicals and just doing regular doctor's visits. Well, money goes into an HSA pre-taxed. Okay, so that right off the bat, that lowers your gross income. That puts you in a better starting tax position right off the bat. The money inside an HSA in most plans can be invested. So, but even if it's just in a cash fund and it's growing at, say, 2%, the growth inside of the HSA is also growing tax deferred. So when in tax deferred, the growth is tax deferred. And the great thing is you're allowed to pull out that money out of the HSA at any time you get ready for qualified medical expenses. And you can go to the IRS website to find out what are qualified medical expenses. And it's a big list of stuff, but you can pull money out of the HSA tax-free. So you never pay taxes on the money. In my personal opinion, I think it's one of the greatest vehicles in the tax code because it allows you to put money in, reduce your tax rate, grow it tax deferred, pull it out tax-free. So again, you never pay taxes on it. So a lot of people are in open enrollment today. So I'm not telling you that, hey, this is personal advice. What I am telling you, though, is to review your options and to take a look at that option and see how it may work for you. Now, what scares a lot of people away is you have to have the high deductible health plan with it. The word high deductible scares a lot of people away. But if you have, say, 50 grand setting in a savings account, you have that high deductible covered. And why in the world someone wouldn't want to take advantage of putting money in an HSA tax deferred and pulling it out tax free later on is beyond me. Why somebody wouldn't want to consider that. And the only thing that I can come up with is the word high deductible scares a lot of people. For me personally, in my HSA, I'm trying to build my HSA up so that when I get to retirement, I have like a health insurance bucket that I can spend from. And, because I wear reading glasses and my dad had to have some expensive dental work done, several thousands of dollars. So I want to have the ability to pull out of my HSA in retirement. So I'm starting and I'm accumulating in that HSA in hopes of having, a bucket for healthcare. You can also use it to pay long-term care premiums. There's a lot of things that you can use an HSA plan for. So again, I don't get paid for promoting HSA plans. I'm not a paid sponsor or anything like that. But what I am saying, it's open enrollment. Take a look at it. And, if you come in for a discovery session and you're looking at us as a potential retirement planning partner, we're happy to help you, just discuss what you should do and what are the advantages and disadvantages of it. And I'm happy to go into a lot more detail in the office. So that is the first half of our show. So If you are catching the 30-minute version, go out to Apple or Spotify, the platforms, podcasting platforms, and you can catch the whole show. Hopefully you got a chance to get out and vote, and hopefully we won't drag this thing on forever. But if you would like to set up a discovery session, you can give us a call at 256-937-2010. Again, the number's 256-937-2010. Call now for your discovery session.
If you're pondering the longevity of your retirement savings with questions like, is my nest egg sufficient? Or how long will my retirement funds last? Consider scheduling a session with Cris Wallace. Text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010 now to set up your appointment.
Cris Wallace and the team at WG Financial Group understand no matter how the 2024 presidential election shakes out, it's going to have a huge impact on your retirement. Now, more than ever, it's important that you have a clear understanding of what's at stake with your finances. Because as we've already seen, anything could happen. Major election surprises, like the ones we've been seeing, can potentially tip the balance on our economy. And on top of everything else, we also know our current tax rates are going to expire at the end of next year. And they'll go go back up. Do you think your finances are ready for all of this? Cris Wallace's election stress test can help you find out. Schedule yours today with the WG Financial Group team by calling or texting ELECTION to 256-937-2010. That's ELECTION to 256-937-2010. See how strong your plan really is. Call or text ELECTION to 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor.
With so many worries in life, market volatility shouldn't be on your list. Help ensure your retirement plan is stable and independent of market swings. Just get in touch with Cris Wallace at 256-937-2010. That's 256-937-2010 to start planning.
And we thank you so much for joining us. This is the Rocket City Retirement Show with my friend and certified financial planner and financial advisor, Cris Wallace. He's president of WG Financial Group. And we're so happy that you're along with us today. And we're going to get into what we're all noticing and the fact that our government debt is just, growing. I think we're at $35 trillion now. Right, Chris? So,
yeah,
this is the thing. We know that with our growing debt, then obviously we're going to have higher taxes, right? No matter what happens with the election, right?
Mm-hmm.
We have to manage the potential of taxation to your nest egg. So, what shifts have occurred in recent years, Chris, that have kind of brought taxes, I should say, to the forefront of retirement planning considerations?
Well, I think, first of all, just while you were talking, I actually just went out and pulled up. You can go to usdebtclock.org.
Oh, yeah. Right.
So basically usdebtclock.org. You can go there. Yeah, it's almost $36 trillion.
Wonderful.
Yeah, so it's like really nearing $36 trillion in U.S. debt. And you can also just for fun, you can look at the state debt clocks too. So that's kind of interesting.
Yeah.
So if I click on this and I just let's see if I can just pull up Alabama real quick. It's taking a minute to populate there. Yeah, so Alabama is like, what is it, like 49 billion at this point. So but you can go check this out. It's kind of fun. It's really wicked on your eyes because there's just a lot of numbers like clicking through here pretty quickly. So if you're listening, you get bored, you want to go home and do something.
Yeah, some people have it on you probably have it on your computer all the time, don't you?
I don't have it up all the time because honestly, I don't like to think about it.
Kind of stresses you out, yeah.
It does, and I think that's where, when we're talking about the future of where taxes may go, at some point the debt has to be dealt with in some way, shape, or form. If not, my kids, your kids, grandkids, great grandkids, they're all going to have to deal with it, and. And one of the ways to deal with it is control spending, obviously, from the government, which they don't know how to do.
No, they don't.
Because one of the ways that they, I almost said market, but really run for office is basically saying, hey, we're going to give you stuff. Well, guess what? Give you stuff is not a good thing.
That's exactly what I think every time I hear that,
Yeah. And as a young person, I don't think you realize that. It's not until you get some gray hair and some wrinkles, crow's feet under your eyes, that kind of thing, that you start to realize you've been duped, by politicians a lot, and to thinking that, they're going to give me stuff. They're going to give me.
No way.
Government, what a lot of people, especially again, young people, don't realize is government spending is inflationary. So when the government spends more money or gives out more stimulus, i.e. devalues the dollar, that's not a good thing for inflation. And while you may think, I'm getting stuff because they're giving me stuff, the long-term ramifications of inflation it can happen a lot easier with higher government spending. And with inflation, it's the tax on all. It does not discriminate. So there's people out there right now today possibly listening to the show. They're in a zero tax bracket. Well, guess what? Inflation didn't come knocking on their door and say, hey, what bracket are you in? Inflation don't care. You're going to still buy the same eggs I buy, the same ground beef I buy. So I think we have to be thinking about that, especially, it's election day and we're recording this. You have to think about that kind of stuff. And that's what I've talked to my kids about. My daughter buys her own gas in her car that she drives. She just drives a Nissan Maxima hand-me-down for me.
Yeah.
But it requires that premium gasoline.
Oh, no.
And so she's buying that gas and like, Dad, gas is killing me.
Aww.
Gas is killing me. Hey, remember that when you go in the voting booth.
That's right.
Right. So I took her, and I voted with her.
Yeah.
So we could talk about, why it's important to vote and,
right. I love that.
just having these types of conversations, because I didn't have those conversations when I was young. I don't recall my parents ever having this with me. That's not a knock against my parents. It's just they didn't have those types of conversations.
Yeah.
So I'm, in the industry, the financial industry. So I want to have these conversations with my kids. So when we're talking about taxes, I think in the past we weren't really thinking about. When I say in the past, years, a decade, 2 decades ago, or whatever. I don't think taxes were a major threat. I do think now you have to worry about it. You have to think about, well, are there things today that I can do to hedge against rising taxes in the future? And obviously, Roth conversions is a great way to do that. But there's been some recent shifts, and the debt has just gotten out of control. Higher taxes on Social Security and Medicare. That's probably coming too, because we've all seen the articles and seen the news clips. Social Security's going bankrupt, and 2032, 2034, they're only going to have so much to be able to to fund, and some are talking 25, 30% cut to Social Security. Again, I'm not in that camp. I don't think that they're going to cut it because there's just too many people on Social Security. I mean, right now, Luann, I don't know if you even know this, but 20% of the U.S. population is on some form of Social Security or Medicare.
That's
so it's a lot.
Of people.
I mean,
that's a lot of people.
It is. So to cut a benefit of, someone like my mom, for example, that just survives on just Social Security.
Yeah, that's her income.
Yeah, to cut that by 25%, I mean, you're talking a lot of people on the street at that point.
And we already have enough people on the street, right? We
do. We do.
Yeah.
So we've got that going on. And then we know at the end of next year, at the end of 2025, there's the tax cut expiration date coming.
Yeah.
So right. I think it's important that, first of all, you look at that, but you need to look at your retirement plan as a whole. I mean, the tax cut expiration date that's coming at us like a freight train, that's a problem. But there's other things you can do to be tax efficient with your retirement plan. I've seen people, Luann, before that have, they have plenty of money. Like they're not going to run out of money. I could retire with them. They have so much money. And feel like, hey, can I go on the trips with you guys? Like,
can I come?
I'll carry your bags and I'll make sure your stuff is taken care of. I'll just, just kind of hang out with you. And
we'll just hang out in the background.
I'll drive you, I could retire with you. But they're inefficient with their money.
Oh.
Just inefficient. I've said it this way before. You may remember this as well. Income covers up sin. So some people have so much income or have so much money that it covers up inefficient sinning that goes on within your spending or how you're pulling money out. So, you can have so much money that it just kind of covers all of that up. And, when we were talking about inflation a few minutes ago, inflation is not hurting the really wealthy people. They can still buy that $12 hamburger, no problem. It's the other generations that aren't in the peak earning years where they're struggling a lot more, i.e. my kids. My son sent a photograph of, I'm not going to say the grocery store chain, but the bag. And he's like, Dad, this was $63. He had like one little plastic bag of groceries.
This is all I got. Yeah. I know.
Yeah. $63. Like, I know. I say, hey, welcome to my world. Wait till you have kids, brother. It gets a little worse.
Right.
It's a little worse on you. Exactly. So anyway, good conversation there. I'll let you move on to your next topic.
So obviously, we're on this sort of unsustainable path. You kind of touched on, I don't know, you want to go to the part about potential long-term impact maybe that this could have on our economy and even individual financing?
Yeah. Financial planning for sure. Yeah. So obviously the debt is surging by nearly like 1 trillion every 100 days. So you could look at it like every year, the debt's just soaring by about 3 trillion a year, which it's crazy. And I think there's a projection that the U.S. is projected to spend close to 13 trillion on just interest payments alone over the next decade. So inflation has been a problem for our government as well, because in jacking up those rates, it makes the debt servicing of the debt a lot more expensive. And then not only that, coming up here in the next few months and years, some of this debt's going to have to be refinanced, and it's going to have to be refinanced at higher rates, which is not good. So if you look at just the spending just to service the debt alone, it's roughly $39,000 per person. That's what it's costing to service the debt, $39,000 per person.
That's terrible.
Yeah. So it's like this big, snowball rolling downhill. It's just getting larger and larger and larger. And I think a lot of us are concerned about the potential for rising taxes. And now I'm not one of these people that thinks that the highest marginal rate is going to be in the 90% like it was in the 1940s. But I do think that taxes, they're going to have to go up. I just don't know how much. And I think, I think it's a good idea to at least have that conversation about, what can I do in the future to kind of mitigate that? And we talked in the first segment about, how to put into Roth and, those sorts of things and maybe do some Roth conversions. But just being tax efficient with your money, especially when your withdrawals, I think is really important.
So, real quick, let me give out your phone number. Got to make sure we do that.
Yeah,
if you have any questions and want to reach out to Cris, he's offering a chance for you to come and see him, talk to him about your own retirement, ask him your own retirement questions, because he is a certified financial planner and a financial advisor at WG Financial Group. Here is the phone number, 256-937-2010. Remember, this is a complimentary discovery session. You can call that number or you can text the word visit to this number, 256-937-2010. And thank you so much for hanging out with us today. You're listening to the Rocket City Retirement Show. I'm Lou Ann Fulmer. So, all right, we were talking about Social Security and, the fact that you just mentioned it, that we may have some problems with it funding, people in the future. In light of all this, is there anything that people can do to protect against maybe these changes that might happen in the system?
You mean with regards to Social Security? Yeah. So I think I mentioned earlier about making really good decisions with Social Security. So just think of it like this. I have some people that are like, I'm taking it to 62, man, because I don't know if it's going to be there. I'm going to take it at 62. And this is the way my brain thinks. I'm like, well, if it's me, I'd rather wait and have a higher amount, because I'd rather have lesser of a higher amount than lesser of a lesser amount.
Right. Yes.
That's just the way my brain thinks.
Me too.
But because it's not going to go broke. It's just not. I mean, are there going to be some changes? Well, for sure. So I think, as far as, how to protect yourself from that, I think it requires good decisions on Social Security. It requires also for you to be efficient in the way that you use your money, and also how you save your money. So I've mentioned this a number of times on the show, and I'll just quickly run back through it. I think one of the first things that they're going to look to do is probably adjust what's called the Social Security wage-based cap. So I think that, that is one area there that they could do is raise that. And if you look at in 2025, it is going up again. So in 2025, if you make more than $176,100, then you stop paying into Social Security. So that means that, let's say you hit that threshold in, September of 2025, then you get an extra 6.2% back in your paycheck, because you're no longer paying that into the Social Security side of the employee tax, FICA. So essentially you get a raise.
Right.
Well, they can take that wage-based cap and they could just raise it really high. So they could take it into, 400, 450. You call the number. And if they do that, that'll help Social Security continue to last for a little bit longer. A lot of people may not realize this, but there is no wage-based cap for Medicare. So when you talk about the 1.45% that goes in for the Medicare side, you pay that no matter how much money you make. So part of me wants to think that they could do that for Social Security as well. Mm-hmm. So that means that someone making $600,000 a year, they would pay in 1.45 for Medicare, and they would also pay in 6.2 for Social Security, and that would make it last a little bit longer. The one thing that I think is really, really, really unpopular to talk about is raising that 6.2% and maybe raising it to, and I don't have the number. I haven't sat down and crunched these numbers. Actually, I really don't care to do that, to be honest with you. But they could raise it 6.2 2, 3, 4. They could take it from 6.2 and go to like 6.3, 6.4, 6.5, and maybe raise it over a series of years to help, pull in more dollars. Now, it's really unpopular to talk about that because that's a tax increase for all of us working, because we now would not pay 6.2, but we would pay, 6.5, for example. That FICA tax hasn't changed since 1990. But if you go to the Social Security website, it hadn't changed since 1990. Now, prior to 1990, there were a lot of adjustments to it. So, but it's really unpopular to talk about that because it's a tax increase. And so politicians, they're not going to get elected if they say, hey, you know what?
Yeah.
We're going to be raising your Social Security tax, 0.3% or whatever. No. Because then you have the other side going, oh, that's going to be X number of dollars hit to every family and blah, 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 and they won't get elected. So they never talk about it. The other thing that they could do is, and this is always fearful for me, is maybe adjust how they're calculating the COLA moving forward. Mm-hmm. So maybe they don't give as much COLA on Social Security. So that can be, something they could do to kind of fix it. Or they could make it more of means tested program. And I think that's the biggest fear for a lot of people out there listening to the show today is Social Security then becomes more means tested, and people that made higher incomes that paid into more. And we talk about the max Social Security in 2025 being $4,020.90. Those people wouldn't get as much because it makes it more means tested. And I don't agree with any, it's not that I'm siding with any one of these things, but this is why I don't think it'll go fully broke. Mm-hmm. And so that's kind of my thoughts there. The other thing too that I want to mention is most of the time when they make a law change, there's usually grandfathering in.
Right.
So the older I get, the more comfortable I feel that I'll be grandfathered in to some degree, to some things. Maybe not on Social Security because they're going to have to do something sooner than I would think I get to the grandfathering. I would say that if you're, in your latter 50s, early 60s, you're probably going to be grandfathered in at some point to what you're getting today. But moving forward, especially the younger generation, I think they better make sure that they're saving in their other retirement plans appropriately and efficiently, as we talk about, to make sure that we can offset any potential changes to Social Security.
Right. Okay. So you mentioned, the fact that the Tax Cuts and Jobs Act is about ready to expire here in another, year, about a year, year and a couple months. So the tax landscape could change. And, a lot of times when people say, oh, taxes are going up, it's just for the wealthy, though. But that's not necessarily true. I want you to explain, if you could, please, Cris, about just, what's going to happen. The expiring provisions of this Tax Cuts and Jobs Act, how it could lead to increased taxes for the middle class, too.
Oh, it's definitely going to hit the middle class for sure. It's baffling to me to listen to these people talk about how they're not going to raise taxes on the middle class. You absolutely are, because it's in law today that at the end of 2025, it expires and the 12 goes to the 15, the 20 goes to the 22 goes to the 25, and the 24 goes up to the 28. So that's the middle class. That's the middle class. Right. Same. Yeah. So to sit there and say you're not going to raise taxes on the middle class, that's hogwash.
That's a lie.
Yeah, totally. So taxes are going to go up, and there's one of the tax brackets, I can't remember off the top of my head. I think it might be like the 37. It stays the same. So if you're like in that 37, I think it was bracket. Yeah. Like, guess what? There's no change for you. Okay. You're lucky.
Yeah. So, you're one of the lucky ones, and you really are, because you're wealthy.
Yeah. So, and that's the higher income earners. So that, I'm doing my quotation, that's the wealthy.
Yeah.
In that kind of bracket. Yeah. And the change hurts the middle class, and that they act like it doesn't. So those are the things that are going to happen unless there's, changes that come before they expire.
Okay. So why don't you explain, why increased tax rates are going to be problematic for so many people in retirement?
Yeah. So I say it could be problematic. We'll say it that way. Okay. Because a lot of us through our early retirement years put in pre-tax dollars, right? So I think when there's something that gets introduced, i.e. the Roth, Roth 401ks weren't around until I think it's 2006, like January 2006, it was introduced. So you could start doing Roth in your 401k. Well, guess what? I don't think a lot of people did that for two reasons. Number one, it's new. And it's like, well, the government introduced something new. I don't trust the government. I'm not going to do it. That's probably one reason. The second reason is it takes a little while for plans to adopt that in the 401k plans. So through the years, more and more 401ks now have Roth. I think now north of 80% of them now have Roth, but that they weren't fully available in 2006 when it was, when you were allowed to do that. So here we are, just really building up that retirement deferred savings. So we never paid taxes on it. And now we're going to get into retirement. And the thought of the brackets changing and going up at the time when we're going to have to pull out those pre-tax dollars and start to pay taxes on that, which then has an impact on our Social Security taxation. So if you just kind of a refresher here, if you're kind of new to the show, if you just have Social Security and that's it, there is no tax. There's no federal tax on it. There's no state tax here in the state of Alabama, even over in Tennessee. But if you start taking money out of a retirement plan, i.e. a 401k or an IRA, and you have to pay taxes on that, that goes on the return, which then impacts your Social Security benefits. And most retirees are on a fixed income. So they have less flexibility, especially if all of their money's in pre-tax and they didn't save it anywhere else. Mm-hmm. They don't have a lot of flexibility. It's like I get my Social Security and my excess money's got to come from here, and I've never paid taxes on it. So I've lost my flexibility. This is why, through the shows we've done, I've harped on trying to create different tax buckets, i.e. why we talk about an HSA, why we talk about Roth IRAs, why we talk about individual or joint brokerage accounts, to give you some flexibility when it comes to how to pull money out in retirement.
Gosh, so I'm sitting here thinking, I'm looking at the people that just have Social Security and then maybe have a 401k or an IRA, but maybe they don't know. They just don't know or didn't know what to do. And yet they're the ones that need the money the most, and I just feel so bad. That's why we're doing this show, is to get this knowledge out there to help people.
Yeah, I mean, some people just, you don't know what you don't know in a lot of cases. Yeah. The search availability of the information that we have today is a lot better than it was 20 years ago.
That's true.
But it's never too late. Like I always tell people like this, it's really never too late to try to make yourself better. And there's still things today, even if you're sitting there, there's still things you can do today. People come into the office all the time and we do our little report card and we're like, hey, did you know you could do this? And they're like, no, I had no idea. Well, guess what? We can. Let's get started.
Yeah. Okay. So that's my question here. Why don't you explain some of the benefits and the pitfalls of the Roth, taking your tax deferred accounts and putting them in a Roth IRA.
Yeah. So just, Roth is after tax. So, if you're listening to the show, again, don't take this advice and run with it. I've had people say, oh, I've been doing what you're talking about on the radio. And it's like, oh, well, you probably shouldn't have, because here's what's going on in your situation. So seek qualified professional advice before you do this. Come in and see us, go see somebody else. As we like to say, if it's us, great. If it's not, find somebody that you can trust to talk about some of these things with. So for starters, Roth is, tax-free in the future. So you're going to put it in, you're going to pay the tax today, and you're going to put it in either your Roth 401k or your Roth IRA if your income's low enough, and you're building tax-free money for the future. So what does that mean today? This is a negative, is you're going to pay more in tax today. So it's going to drive your tax rate up today, because I've had people come in, this is like stories of people, hey, I was doing all pre-taxed and now I'm doing all Roth. I'm like, did you take into account, your tax, hit that you're going to take today? No, your taxes are going to go up, especially if you're putting in $30,000, pre-tax, then all of a sudden you're doing Roth and you're in the 22% bracket, you're going to see a pretty healthy federal tax increase. Now, you may be okay to accept that because, again, the benefits in the future are tax-free. If you do a Roth conversion, because, again, they're very popular today, I think they're advantageous for a lot of people. If you do a Roth conversion, that's a taxable event today. So same thing as if you're doing contributions. You're taking a tax hit today. If you do a Roth conversion, it creates a taxable event today. Now, the downstream effects of having tax-free income and all of that, I think is probably beneficial for a lot of people. I'm not going to say, everybody, but I think a lot of people, it makes sense. Just as a side note here, that if you do a conversion, you do have access to the converted principal right away. It's the earnings and growth where you have to wait 5 years. So I just kind of wanted to throw that in there.
That's good.
And the reason I think Roth are helpful is because you may especially when you get to required minimum distribution age, you may be pushed into a higher tax bracket. Pulling out for retired minimum distributions. Now, there are some other strategies that we can use. I like to call it like tax bundling, because everything is bundle this, bundle that, which I hate the word bundle. Yeah. It's like, oh, get your home and auto here and your life insurance, and you get a bundle and you get a better rate. Yeah. Well, I use tax bundling when it comes to charitable giving, and there's just ways that you can do that to lower your tax bracket. But if you have all pre-tax money, the potential for you to be in a higher tax bracket in the future is there. And if you go into a higher tax bracket, it means you make more income because you're having to pull more out. Now you can have further taxes, as we mentioned, on Social Security, but now we got another person that comes in the door, and her name is Irma.
Aunt Irma? Is that an aunt?
Aunt Irma. I've heard people, a buddy of mine calls it Aunt Irma. I always like to say we have two sisters in retirement that we don't like.
Yeah, that's what you say, yeah.
Yes, and that's Iris, and that is Irma.
And Irma, yes.
And we don't, they're always coming in, they're always wanting money, and we want to be careful how much money we give them, and we can actually control that if we are smart with how we pull money out, how we convert, etc. So again, as you have more pre-tax money, you're going in a higher tax bracket, now you're paying more on your Social Security, and now Irma walks in the door. So that's important to know. There's multiple levels to Irma. Before you know it, you're paying a significant amount on your Medicare Part B premium. I've had people come to the office before and say, Chris, I sold a house and I made good money, and I had no idea that all that capital gains was going to go on my tax return and then cause me to go through the Irma limits. Because what happens at age 63, this is an important age for you to remember, is that when you turn age 63, Medicare starts looking 2 years back on your tax return. So at 63, Medicare starts paying attention to how much money is on the return, because that'll determine what your Medicare premiums are going to be moving forward. Now, there are ways to get out of it in some cases. You can use what's called Form SSA-44, and there are some, I think there's like 7 events at the top, and you can mark 1 or 2 or 3 of those, however many, that at times you can get out of it, but it doesn't work all the time. Like, you can't say I sold a house. That's not one of the life-changing events there. Retirement is one of those, but not selling a house. So there's just a lot that goes into these taxes, Luann, and I know we're creeping up on the end of the show, so I've actually got to cut off talking about taxes. I could go on and on about this.
I love it.
But it's a really important part of your retirement plan. I think it's one of the often overlooked areas of retirement planning, because I think investment advisors, well, how much money do you have? And I can make you X number of return. Well, our conversations are different in the office. When we have conversations with family, we follow my Rite Retirement process. We're looking at retirement income, your investments, taxes, and estate planning. We're going to make sure that your situation is looked at from a holistic standpoint, because it's not just about the returns. Who cares how much money you make if your largest expense in retirement ends up being taxes? For me, I want to be efficient with my money. I want to make sure that my retirement plan is built in an efficient manner, that I'm paying taxes that I owe, that I legally owe, and I want to be as efficient with that as possible. So if you'd like to come in and sit down and go over all of this in what we call a discovery session, you can do that by calling 256-937-2010. Again, the number's 256-937-2010. Luann, it's been a great show. Again, I hope everybody got out and voted, and we'll see how this thing turns out in the future. Hey, at the end of the day, it's in God's hand.
That's right.
And because I said God on the air, they're going to throw the religious disclaimer on there again. Hey, but at the end of the day, it is in God's hand, and we don't have to worry about it. I hope everybody has an awesome and blessed week, and remember to serve every person in every situation with a servant heart.
AE Wealth Management LLC provides services without regards to religious affiliation, and the views of individual advisors are not necessarily the views of AE Wealth Management.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management LLC, a registered investment advisor. Insurance products are offered through the insurance business is WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.